conduit CMBS, the bread and butter of CMBS, historically really like lent itself best to loans, mortgage loans that had 7-year or 10-year terms, because the buyers of the bonds were a lot of the buyers of the senior bonds were life insurance companies, and they wanted assets that were going to be outstanding. They wanted long dated assets, right? So the longer the mortgage is in a CMBS deal, the longer the bonds are outstanding. When we have an inverted yield curve, borrowers don't want to lock in long-term financing, right? I'm a borrower. I don't want to go and take a 10-year mortgage and get locked out, because if I look at the forward curve and I see that rates in a few years are expected to be lower than rates are today, I don't want to be locked into a high interest rate loan. So I thought at the beginning of, this significant yield curve inversion that CMBS was going to be in a lot of trouble, right? What ended up happening was that CMBS originators started to experiment with deals consisting mostly of 5-year loans, and they found a buyer base for those. So, in spite of expectations, the conduit market continued when many people thought that it would be completely shut down. The other part of that question, though, has to do with not new CMBS and new transactions, new originations, but the performance of existing deals. And I think that is going to be a big problem. I think it's kind of a weird time right now, because things don't feel as distressed as they should to me. But as you start seeing loans coming up for refinancing and the values of properties get rewritten or marked down, right? Because interest rates rise. When interest rates go up, cap rates tend to follow, which means property values go down. There are going to be a lot of loans that are going to come up for refinance that are not going to be able to get refinancing at all, right? This is some of the office properties that we talked about. Or even if they are able to get refinancing dollars, they may not, or probably won't, be able to get the same amount of dollars, the same amount of leverage. And so borrowers are going to have to come out of pocket to make up the difference, or they're going to have to get like preferred equity or mezzanine debt, which is a lot more expensive than first mortgage debt, to make up the difference. So I think with $1.5 trillion of loans coming up for refinance, not all of which are CMBS, but some of which are, you're going to see a lot of defaults. You're going to see a lot of loans have problems, and you're going to see a lot of more sponsors hand back keys.